This Week in Economics on the 18th of December 2016 as we move along here in the month of December, finishing up Q4 from WBRN Radio in Boston and on the Bostonred Network, which can be found at bostonred.org. Also, we had another program today on the Bostonred, which is our political program on the Electoral College. Nonetheless, let's start this off. We talked about last week's edition. Actually, was our forecast edition. Hysteresis. Hysteresis being an economic term, and we'll just implications from statistical characteristics of unemployment, redundancies, unemployment rates exhibit hysteresis. Then it follows a statistical non-stationary process because the expected value of the unemployment rate now and the future permanent shifts when the rate itself changes. The process with hysteresis is a unit root process, which is simply form can be characterized as UT equal UT minus 1 plus E 1, okay. Anyway, we won't get into that, but when some negative shocks reduce employment in a company or an industry, enterprise, whatever, there are fewer workers left, and as the workers usually have the power to influence a set compensation or wages, their reduced number incentivizes them to bargain for higher wages when the economy gets better, instead of letting the wages stay at the equilibrium rate or wage rate there when the supply and demand of workers could match. This causes hysteresis. Hysteresis, i.e. the unemployment becomes permanently higher after the negative shocks. Now, we have a new study here, and we'll just briefly do it, and then we'll go to Uber and actually what is happening out in California. A lot of this is on Blanchard and Summers in 1986. The world's macroeconomic experienced a massive financial and economic crisis in 2008, with the early phases seeing collapse in important macroeconomic variables that were strikingly similar to those during the worldwide Great Depression. Now, there's a big argument there, and some of us call the 2000 experience a depression. Now, that is from Etchgreen and O'Rourke in 2009. While global policy responses have improved relative to the 30s, a complete recovery is still incomplete in North America, Europe, and Japanese economies. The employment situation continues to be disappointing in the U.S., with low levels of job creation persisting years after the start of the crisis. Recently, the matching of workers to jobs has worsened as more job openings have coexisted with with higher unemployment rates since 2008. This could be seen as an outward shift of the Beveridge curve. We talked about that before, which plots the relationship between job openings and unemployment over the business cycle. One set of explanations for this elevated mismatch in the labor market, including sectoral shocks. Two are technological changes that we'll get to with Uber in the labor market, which make employers need less well-matched to workers' skills, a structural mismatch. And we do have indeed structural mismatches. While structural explanations are popular today, and they were popular in the 30s, another explanation for increased mismatch could be higher unemployment, harming the ability of the unemployed to find work, leading to persistent higher unemployment, which is called hysteresis, in unemployment. The theory was outlined by Blanchard, and Summers in 1986 as an explanation for persistent high employment in Europe after the 1970s. I find support for hysteresis in unemployment as the beverage curve shifts out when output is shrinking while inward shifts take place during expansions. This effect is especially prominent during effectively on limited labor demand that was in the Second World War, which decisively ended the hysteresis problem. Returning to normalcy could be seen in the beverage curve in the 50s, which resembles that of the 20s. Now, 20s were a boom time. The similarities of those 2 decades is often attributed to the tendency of market economies to self-equilibrium, but without a wartime labor demand, the problem of long-term unemployment would likely have persisted, and a weak labor market would likely have persisted through the 40s. Now, in the 40s and 48, you had some recessions. When the beverage curve is disaggregated by dilution of unemployment, the beverage curve stays in the same position for long-term unemployed, while the entire shift onwards takes place among the, did I say short-term or long-term? The evidence for this is today is consistent with hysteresis effects. I find that hysteresis was a problem in the Great Depression. While the war ended the hysteresis problem in the 30s, the prospect of a similar surge in labor demand to address our current hysteresis problem seems unlikely. So the weak labor market will likely persist for many years, using a search and match framework, as in Morstan, and we don't have Morstan here. I estimate the impact matching efficiency of the unemployed to jobs over time, while showing that the market decreases in matching effectiveness during the 30s, a major improvement during the 40s, and a return to normalcy in the 50s. I've conducted counter factual simulations in which match the efficiency does not always fall during the Great Recession. The effects of hysteresis on the labor market are removed from the 2007-2014 period. American employment is higher by 12 million workers. This slow recovery from depression is consistent with hysteresis effects, confirming the results of Gordon, who found that the America of 1939 faced a low employment equilibrium trap. For the current situation, that I find employment would have recovered to less than 4% below the trend, while the actual path of employment shows little to no reversion to trend employment. These problems are tied to recent concerns about secular stagnation, as can be found in Summers in 2004. He came out 2014, given the recent low investment rate and low capital stock, low rates of employment, the perspective for recovery are bleak, as the perspective for rapid recovery seems increasingly and unlikely. The long-term unemployed will likely continue to leave the labor market. That is from Kruger a lot in 2014, and the labor force will as a result be permanently smaller. Now, in the 2016 campaign, it was argued that it could be boosted. Now, this is by Maffei of American University, Gabrielle P. Maffei of American University, on the 6th of March 2015. We'll leave Patrice's here and move on, but we'll move on to Uber and what is happening in California. Let's see if we can find that particular article here. I believe it was in the Santa Monica newspaper, where the state of California took on Uber, that Uber needs a permit to operate their self-driving cars, and let's see if we can find it here. Maybe we won't, but we do in fact. I think maybe that's at the BBC. Anyway, nonetheless, let's move to the market, people. The whole idea there is that Uber is moving as quickly as possible from their present business model to self-driving cars, which would replace the Uber workers. There's dispute with Uber as to if those workers were contractors or not, or just ordinary workers. The ordinary workers have won out in many states. So what Uber has decided to do is go to robotics. Now, at the present time, they actually have a driver in the self-driving car, but that driver will disappear. On to market. This is the market flash manufacturing PMI. Hit a 21-month high during December, and this was released on the 15th of December. And U.S. manufacturing reported a strong end to 2016, with business conditions improving at the fastest pace since March of 2015, up fractionally from 54.1. Above 50 is considered a rise. Continued its recovery from post-crisis low seen in May. That was 50.7. The headline PMI signaled a boost improvement in the manufacturing sector's business conditions, with faster job creation, stock building offsetting slightly likely to moderation in output new orders since November. Moreover, the latest rise in pre-production investment was the strongest recorded since the survey began in 2007. Manufacturers noted that greater stock accumulation reflected stronger optimism towards demand outlook, alongside faster than expected new order growth in recent months. Manufacturing output expanded for the 7th consecutive month in December, whereby signaling a significant rebound from a salt patch that was in the second quarter, Q2 of 2016. The rate of production growth needlessly erased October's 20-month peak. Survey respondents noted that greater sales and efforts to replenish inventories had driven up production volumes at the end of 2016, reflecting stocks of finished goods rose the third month running, and most marked a pace since 2015. December's data reveals a robust upturn in new work received by manufacturers, with the pace of expansion holding close to a 20-month high seen in November. This was overwhelmingly attributed to improved domestic demand conditions, while export sales were close to stagnation, which contrasts with modest growth seen on average in the second half of 16. Improved business conditions led to increased staff hiring across the manufacturing sector in December. And December normally in the U.S. is a slower time. The rate of job creation was the steepest for a year and a half, which helped to alleviate pressure on operating capacity. As a result, the latest rise in backlog work was only marginal and the smallest in 3 months. Greater purchasing safety continues. Purchasing activity continues during December. Input buying was linked to increased production schedules and efforts to boost inventory, as highlighted by the survey's latest data. Of supplier delivery time were broadly unchanged since the previous month. Input price inflation accelerated for the third time in the past 4 months during December. Moreover, the latest increase in the average cost burden was the largest since October of 2014. Manufacturers cite higher steel prices in particular, alongside general rise in raw material costs, including oil petrol. This continues to have an upturn in factory gate charges for the third consecutive month, although the rate of inflation remains only modest. This is a comment here from Dr. Williamson. U.S. manufacturing is enjoying a strong end to 2016, showing further signs of pulling out of the salt patch earlier this year and putting the sector on a starting block, nearly ready for a future upturn as we move into 17. Q4 seems the strongest PMI reading for 1.5 years, suggesting good producing sector is growing at an amortized rate of 2 to 2.5%. A buoyant domestic market reflects a combination of rising consumer demand and inventory building, is helping offset export woes caused by the strong dollar. Companies are gearing up for future growth in the coming months. Employment is rising at the fastest rate for 18 months. Purchasing activity has likewise been ramped up by preparation for higher production. Confidence among producers has clearly improved, setting the stage for a good start to 2017. The upturn is being accomplished by rising costs, likely mainly to global commodity prices, lifting higher. The combination of solid growth and rising price pressures add to the likelihood of further Fed action with more than 3 quarter point hikes anticipated next year by IHS. That seems to move with some forecasts that the economy is basically, given structural changes out there, hypothesis, if you want to call it that, is in a good condition. Now, depending on the next administration, what their policies are. And this is one of the, I would say, caveats that it happens if you have, and we'll talk about energy pricing in a minute, but as energy pricing improves in Q1, Q2, Q3 in 2017, that will also drive up costs. Now, and at the same time, the Fed will be acting at least 3 rate hikes there, perhaps 4 will be needed to keep inflation at bay. We at this mic feel that the rate of inflation could go to 2.5 to 3% to pull out some of the slack in the economy. Now, also, there's a question of immigration. What immigration will do to the economy, we'll leave that open at this point in time. Let's go to the market Flash European Zone PMI, the Flash European Zone PMI composite output index 53.9, which is good. It was unchanged since November. Flash Eurozone service PMI activity index 53.1. It was actually 53.8 in November, a 2-month low. Flash PMI manufacturing output, this is for the Eurozone, at 56.1 is 54.1 56.1 now, it's 54.1 there. It's a 32-month high. Flash Eurozone manufacturing PMI at 54.9. It was 53.7, the highest in 68 months. The Eurozone maintained a robust pace of expansion at the end of 2016. That's according to PMI survey. The market PMI held steady at 53.9 in December, according to flash estimates based on around 85% of the usual monthly survey respondents, indicating that business activity drew at a rate identical to November's 11-month high. Inflows of new business employment backlogs of work also rose at similar rates to November. Manufacturing-led growth. December saw an acceleration in manufacturing growth linked in part to a weaker euro, offsetting a softening of growth in the service economy. The headline manufacturing PMI rose to the highest since April of 2011, rebounding the largest increase in output since April of 2014, accelerating growth in new orders. Employment producers reported that orders were buoyant by increases in competitiveness resulting from depreciation of the euro. The overall rise in both new orders and exports was the highest over a 5.5 years. Purchasing activity was also stepped up as manufacturers responded in an upturn, in demand, suggesting firms were expecting factory orders to rise as we move into 2017. Now, reverse effect there that the consumer economy was not in it. Exports were there. Weak euro worked out for the EU. The expansion was needlessly in line with the average seen in 2016, and with service providers' expectation of activities in the year ahead jumped to an 8-month high. Companies expecting growth to pick up in 2017. A key development in September was further intensification of inflation pressures, a combination of higher import costs resulting from euro depreciation and rising global commodity prices, meant an average input price rose at the sharpest rate for 5.5 years, which showed the biggest jump since May of 2011. However, service providers also saw a bigger increase in costs for 4 years, in part driven by, again, fuel and oil prices. Average selling price for goods and services rose at the sharpest rate for nearly 5.5 years as firms passed higher costs on to consumers, with the survey showing supply chain delays to be at their most widespread since June of 2011, and backlogs of work across the economy growing to the greatest extent in 5.5 years. The survey suggests that capacity is being strained in the recent rise in demand, since capacity shortages tend to spill over into high prices in the following months. The preliminary breakout in December's PMI shows growth continuing to be led by Germany, despite the pace of expansion slipping to a 3-month low. Growth in France, meanwhile, accelerated to the fastest for 1.5 years and the second best since 2011, though still lagging behind Germany. The rest of the Eurozone saw growth rise slightly compared to November, 9 months high, caused by a slower service sector. In Germany, France, and the rest of the single currency bloc, growth was driven by accelerating expansion of manufacturing output, supported by ongoing growth of the service activity. Comment here from Dr. Williamson. The Eurozone economy is ending 2016 on a strong note. The PMI indicates that business activity has risen at a fastest pace so far this year in the fourth quarter. Secular GNP growth 0.4%. Manufacturing business conditions are improving at the steepest rate for 5.5 years as the weaker euro provides a boost to exports. Service sector optimism about the year ahead has meanwhile risen to an 8-month high, suggesting companies are largely shrugging off political uncertainty for this time at least. And Eurozone economy is on strong footing to start 2007. There's clearly the potential for political uncertainty to derail growth. Elections loom in the Netherlands, France, Germany, and the basic discussions. We'll get to that in a minute. However, the most significant development in December is the intensification of inflationary pressures, rising global prices for many commodities. That is always a problem. Oil and metals are in that, is being exacerbated by a weak euro, pushing prices up at the sharpest rate of 5.5 years. So when the PMI surveys point to the economy gathering strength, the upturn is being accomplished by a rising inflation, a scenario that will please the European Central Bank. Germany is leading the upturn, where the PMI is indicating a solid 0.5 expansion in the closing quarter, while France is also picking up steam in the PMI growth of 0.3% there. So that is where we are in terms of the overall market. Let's go to the Goldman Sachs and the hike in oil prices outlook. Expects higher complacency for oil output cuts. Investment bank Goldman Sachs revised its crude oil price forecast for Q2. That's just Q2 of 2017. It upped the price outlook there to $57.50 from $55. That's for West Texas Intermediate. T-Boone Pickens is no doubt very happy. It also raised the forecast for the international benchmark Brent crude at $59 from $56.50 as much hype, production cuts by OPEC and non-OPEC nations. There will be little evidence of the cuts until mid to late January. It's always usually about a 3-month lag there, but again, those price cuts went out. It's about 2 months. Ultimately, our work on Saudi Arabia's fiscal balance suggests that the kingdom has a strong incentive to cut production to achieve normalization of inventories, even if it requires larger unilateral cuts, consistent with comments last week by the energy minister. Given the incentive to cut and the light of OPEC and non-OPEC cuts announced over the past 2 weeks with slight rise of their IH-17 production, they expect 84% compliance to the announced collective cuts of 1.6 million barrels a day. Beyond HI 2017, we expect global prices will remain balanced. Brent crude between $55 and $60 a barrel. Remember, at one time it actually hit to $100 per barrel. So this was based upon the Reuters. Basically the same thing. Tight petro prices there, and we're at $52.61 a day. We'll get to it in a minute. That is on the benchmark there, $52.28 on West Texas Intermediate. So Reuters commodities analyst Wang To said that Brent and West Texas technical chart indicators are bullish, with the next resilient point seen at $55.79 and $55 for both. We'll look at that. In the U.S., which does not participate in the agreement to cut output, drilling production has increased to to 7 week strength. Drillers added, this is where we get to Baker Hughes, hadn't had them up in a while, added 12 rigs this week, on December 16, bringing the total rig count to 510, the highest since January, thus still below the 541 rigs a year ago, that's according to Baker Hughes, since it is toughest on May the 27th, 16. Producers have added 194 rigs, that is, in the U.S. That's according back to Goldman Sachs here. The result of oil production is edging up, rising from 8.5 million barrels per day in July to 8.8 million by mid-December. So that is from Baker Hughes. It is going up, more activity out there. How much more activity the world can accommodate is a very, very big question, and always will remain a question. Let me go to the BBC and finish this up. High notes, I believe the UBA, well, wait a minute, let me make sure of this. Joint call for EU state and EU citizens to stay in the UK. That is a very, very big concern out there. The UK British Chamber of Commerce, which represents companies, and with a combined workforce of 5 million, and the TUC, which called in an open letter there, that's the trade union, failure to do so would damage the EU economy. Downing Street said Mrs. May, as she is the Prime Minister, to protect the status of EU nationals, wants to. The General Secretary, this is Francis O'Grady. Anyway, we call upon you to demonstrate leadership by providing EU citizens in the UK with reassurance that we expect to show UK citizens across the continent. There were 2.1 million EU member nation working in the UK this year. That was 224 more than the total for the first 5 months of 2015. Now this is 27. The right thing there. Business communities across the UK are deeply frustrated that the ministers have declined to guarantee the residency rights of EU workers, or employees as they call them. And O'Grady said continual doubt about the status of workers from the rest of the EU is bad for business, no doubt about that. And those are one of the things that is in the air, and evidently will remain in the air for some time to come in the EU, and will affect the economy over time in the UK. Abu Dhabi evidently has taken a 2% stake in BP, British Petroleum. And take a quick look at it here. One of the biggest stories there will take a 10% share in Dadco, which owns the offshore oil fields for most of Abu Dhabi's production. So in other words, BP will take a 10% share there, and at the same time Abu Dhabi will take a 2% stake in BP. That is basically worth £2 billion. That would put Abu Dhabi top 10 shareholders ahead of Kuwait, which owns 1.7%. So effectively 4% of it is now owned by various, I guess you'd say, clients, which has changed some of the thinking perhaps there. Very difficult to say. Thousands of workers set to strike. We'll take a quick look at this one, then we'll go just do the numbers. The strike in the Christmas week is the headline here. Hundreds of Crown Post Office walk out on Monday, Tuesday, and Friday. The action is a major escalation dispute over pension charges, job security, etc. at the post office. Be joined Wednesday and Thursday by workers who supply many of the sub-post offices with cash. A spokesman there. Meanwhile, REMT members at the South Rail will strike on Monday and Tuesday. That action there at the South Rail. The British Airways cabin crews belong to Unite Union are due to strike on Christmas Day and Boxing Day, a major holiday in the EU. Unite members employed by the Swiss port as baggage handlers and others at 18 airports across the UK are set to walk out on Friday and Saturday over pay. So members of the Transport Salaried Staff Association and the REMT on the London Underground, the subway in other words, are also continuing with an overtime ban in the dispute over jobs. Ticket offices closures, pilots at Virgin Atlantic will start a work contract action on Friday. So in other words, Happy Christmas will not be as happy. Let's go to the market data and end this up. Incidentally, we'll be moving back to some other channels hopefully here, and we'll make that announcement when we get there. But at the current rate, where we are. We'll try again. Yeah, here we are. Nonetheless, the BBC Global 30, it's now Monday, is negative 15.11. These are Friday, unless otherwise noted. The FTSE All-Share at 6.26. That's on Friday. In Amsterdam, they were at 1.18 on Friday. The DAC in Frankfurt is at 119.25. In Paris, they were at 14.04. In Brussels, 12.90. In Madrid, 72. In Zurich, 13.42. In Moscow, they were down on Friday, negative 5.82. In Johannesburg, they were also down 294.82. In Bombay, they were down 75.23 on Sunday. In Karachi, also on Sunday, they were at 226.18. In Lahore on Friday, they were down 45.11. In Colombo on Friday, they were also down 16.82. In Tehran on a Sunday, they were up 25.40, again 25.0 in the positive. In Sydney on Sunday, they were up at 31.10. The Nikkei on Sunday was down 37.42. The Hang Seng on Sunday was down 168.87. In Shanghai on Friday, they were up 5.30. In New York on Friday, they were down 8.83. They had been up during the week. And the NASDAQ was down 19.68 on Friday. The Merck, that's the commodities market out in the Midwest city of Chicago, was down 3.96 on Friday. And on Monday in San Pablo, they are down 1,046.17. And in Mexico on Friday, they were also down 755.57. And on to the commodities. We went through some, but we'll go through all now. Reiterate here. Nonetheless, Brent crude we have on Friday here the pricing at $55.33. The spot was at $55.14. West Texas Intermediate was at $53.08. Cocoa futures were down $4. Coffee futures, C-coffee futures were down 10 cents. On the Forex, gold was at $1,134.85. It was up $2.40. Dubai gold was up $3.50 at $1,136.50 futures. And let's go down here to the Euronext Life futures. Cocoa was down there at $3. Robusta coffee futures were up $23 there. The Bloomberg Commodities Index on a Friday at 87.13, or it was up 0.3%, or 30 cents. That was on Friday. So we have it, the week in a bag. We're back to our regular schedule on This Week in Economics. We anticipate a summary of economic activity of 2016 sometime next week. We'll be having some more programming in here, and we'll also be looking at the structural effects of unemployment and technology and see exactly where we end up with it as we dive down on the various papers out there to see if we can understand what is happening. Now, incidentally, one of the factors that they stress is, quote unquote, the safety net, what is called unemployment insurance. Now it's Gabrielle Maffei here, and she's at Gabrielle at American University. Check it out exactly who, but anyway, hysteresis and persistent long-term unemployment. Lessons from the Great Depression in World War II. To reiterate, World War II was a stimulus that literally got the country out of the Depression. Now, there's a little difference here. The Great Depression, we used to just call it the Depression. Those of us born in the 50s heard about it because many of the old-timers were around. The 50s were effectively just 20 years, actually less than 20 years out of it. And the start of the war in the early 40s till 1945, there was a recession, I believe, in my memory here, in 1948. So by the time we got to university in the late 60s / early 70s, it was still fresh on people's minds because if you look at it, you were only roughly 30 years out of the war and 30 years, a little over 30 years out of the Depression. So you had that, and then you, of course, had the robust 50s and the 60s and high inflation. 70s were coming upon us. And then, of course, we had the Reagan administration and their market-type economics. We'll get to that later. But, again, the unemployment insurance, that was one of the reasons that many of my professors felt we would not go through another Great Depression. However, we've had a systematic elimination of that safety net, and many states have little so-called unemployment insurance left in the tank, so to speak. And then if you look at other sorts of things there, food sufficiency used to be called food stamps, and then the National Health Program, Obamacare, that could be leaving us, and Medicaid. So you start looking at this, and then you have the long-term unemployed, or what Marx called akin to the reserved army of the unemployed. So you defining those two groups, but this long-term unemployed or underemployed or whatever you want to call them, they are there. And how many of those people you will bring back into the force depends on the type of workplace situations you're looking at. Obviously, when you look at manufacturing now, many of the manufacturing jobs have gone tech, if not high tech. Robotics, of course, have been in the automobile industry for many, many years. The Japanese put that in, and in many other plants, you will see various types of robotics or whatever there. In fact, the guy that is to lead the labor department, he comes from the Carl Jr. restaurant empire in California, was talking about putting more and more robotics into his fast food restaurants. So in other words, the burgers will fly out there and the robot will greet you. That has been in warehouses for a very long time. If you look at Amazon and those people, more and more robotics are there. But also more and more people, because they're building larger and larger and larger warehouses. So what on warehouse workers, you look at self-driving cars, Uber first, and then you will have your taxi cabs, and the cost of fitting those cars, because you have more than Uber, you have Google out there, you have all the major automobile companies going into self-driving cars. You have Tesla that has a semi-self-driving car that can help you parallel park, etc. So more and more of that technology is coming there. Next, you will have buses, planes more on auto, like drones, and this will effectively start to replace the people component. The people will be basically accessories to the robots. In other words, your quote-unquote personal care. You'll have people there taking care of that, but they will not be paid as well. So this is part of what a modern economy faces. So we have to look at what is going on here and making our safety nets as stronger. Because the old idea that everyone can get a job that's willing to work is going out the window. Now, in some countries, such as the U.S., your labor participation or labor force participation rates down because of us baby boomers that are retiring. But perhaps the new Social Security legislation, I was talking to a lady today that had turned 50. She probably will not be able to fully retire till 67 or perhaps even 68 with maybe less benefits. So that's a long time. That's 15 plus years before she can retire unless she's disabled or something. So in other words, that changes the whole dynamic of workers and healthcare, whereas now healthcare is up because of, again, the baby boomers. But the baby boomers in the next 25 years will disappear. That's all, folks. We'll talk to you next week. As the legendary broadcaster Paul Harvey said, good day.